Morning, traders. This is Coach Ernie. How you doing? It is Wednesday, April 1st. I don't have any April Fool's jokes for you. That's a good thing. It's another day in paradise. So we'll get right to it. Let's talk about what we've been doing for the past 2 days, and then today is the culmination of it. And just so if you're wondering what this show is all about, this is called the Zero DTE War Room. And I'm here to help you through zero DTE strategies. We'll learn all about taking convex positions or positions that have extreme asymmetry. That means really small risk, large potential profit, and how to trade that way in a way that will overall give you a new lease on your trading life. I can guarantee you that. It's very different than what most retail traders are doing. This is actually a more professional approach, where we are defining our risk as opposed to trying to fight it every single day. We define our risk to be so small that, quite frankly, we don't have to manage it. And instead, we flip the script. Instead of managing our risk, we're managing profit. Now, that doesn't mean that you're in profit all the time. Of course it doesn't. There is no such thing. However, you'll find that this methodology will limit your drawdowns dramatically and increase your consistency and your bottom left top, in your view, bottom left top growth of your equity curve, which will allow you to compound, because that drawdown is the killer to compounding. So anyways, this week we were focusing on routine, and the daily routine, the weekly routine of trading. And essentially that's broken down into 3 parts every day. There's preparation, execution, and then there's reflection. Today is all about reflection. And it's not just about reflection for the trading day, but it's how to close that loop at the end of each week so that you can turn your routine into a continuous improvement habit. And so that's what we're doing here. Monday, we did preparation, and we're still going to go through all 3 of these things every day, but just to reinforce that habit. Monday, we focused on preparation for the trading day. What do we do pre-market to get ready for our trades? All right, and we'll do that in a second. And then yesterday, we talked about execution. That's where you find an entry event, a reason to get into a trade, execute that trade, manage it throughout, manage the profit. And although we never really got to actually exiting the trade yesterday, and I'll go through what yesterday looked like. And then today we're going to talk about reflection. All right, that's probably the most overlooked part of a trading day for most traders. And in fact, probably the most important part of their trading day. And the reason for that, let's step back a little bit and just think about what trading is on a day-by-day basis for a day trader. And you can equate it to a scientific experiment. Every day, we're developing a hypothesis. That's our preparation. We're finding out what the market entails and then where we think we're going to execute a trade. And then there's the actual execution of your hypothesis, the experiment, where you're gathering data, you're pushing the buttons and all that. And then at the end of the day, you want to gather all that data and record it so that you can then repeat the whole process over again, because typically when you're in the scientific process, you're learning from each experiment and using your findings to re-inject it into your next hypothesis. And it's the same thing with trading. We're going through that continuous loop every day, right? Preparation, execution, reflection. Then take what we learned from there, bring it back in, and if we've learned anything that might alter or modify our preparation, we do that. And then there's the bigger picture where you step back and you want to close that continuous improvement loop. So each day is like an experiment, Monday, Tuesday, Wednesday, all the way to Friday. You've created 5 experiments. This week it'll be 4. And you then reflect on what you've accomplished. Was it a good week, bad week? Of course, good and bad have to be contextual. It doesn't necessarily mean winning, losing day. What it really means is how well did you execute your daily routine. And you figure out, okay, how does this week stack up against previous weeks? And that's where you're going to get your trajectory. Are you doing better each week or not? Are you learning from those experiments or aren't you? And if you're not, why? Typically, when we do this reflection, we're looking for those abnormal things or those things that are outside of where we want to be. And when we find areas that are less than desirable, we need to figure out what's the root cause. The only way that you're ever going to figure out what the root cause of a problem is through this routine and that process and that reflection. If you don't journal, if you don't log your trades, there will be nothing to reflect on. If there's nothing to reflect on, there's no opportunity to improve. It's as simple as that. Otherwise, you're just, you're a sheet in the wind. Wherever the wind blows, that's where you go. And when you find a lack of performance, what do? You go and you look for a different strategy or a different method, or what is this guy doing? What? Oh, look, there's a squirrel. You can't go through life like that. You have to stick with it, develop the discipline, figure out exactly what you're doing wrong, what could be improved. All right? And really, the only way when you come across points where you know that there's something wrong, we have to figure out why. Until you figure out the why, or let's first of all say that the very first step, I'm going to go through the 4 noble truths of your discovery of how to fix problems. First, you have to understand that there is a problem. Some of you may never think that there is a problem with you in your trading. It's probably the market, right? Or maybe people were yelling at you, or there was an earthquake, or bad storm, or just a bad day. The market's against me. It's those damn market makers. So you can come to grips with the fact that virtually everything that you do in the market is your responsibility, your fault. And you have to figure out and come to grips with the fact that it is you and that there is a problem, number one. Secondly, you need to find out what is the root cause of that problem. What is causing you to make that bad entry every day? Are you filled up with some sort of anxiety? Are you not getting enough sleep? What is the root cause? Once you've found that root cause, then you need to develop a cessation to that problem, a fix, right? How can I correct that bad behavior? And then once you've figured that out, correcting the bad behavior, you may think is just, I figured out what it is. I'm just going to now start doing that and it's fixed. And yeah, that's the first step. But the fact is that if you're doing something consistently, you've developed a negative habit. And that means that you have to then reprogram yourself to create a new habit. And that reprogramming process can be long and arduous. Developing a new habit, they say, can take anywhere from 33 to 60 days. So that means that when you've discovered a bad habit that has emerged in your trading and you need to fix it, that means that you need to then practice it. Practice the remedy over and over until it starts becoming ingrained in you. And that's something that I talked about in the very beginning of this series. I said that there is a secret to trading success. What is that secret? From the big point of view, it's practicing your routine. But your routine is nothing more than a series of habits. You develop habits for your preparation, for your execution, and your reflection. Every single one of those is a series of individual routines that you go through. You can call them ceremonies, you can call them habits, fundamental actions, whatever they are. You need to identify each and every one of them and what they are in those 3 major categories and practice them over and over. And then at the end of each week, at the end of each day, you reflect back and see, how did you do? Are you following the right script of what you planned on doing? Or are you deviating from it? So important. And a lot of people talk about what is the key, and they say it's discipline. But discipline is an empty word without something to be disciplined upon. And I'm giving you the tools right now on how to find out what it is that you need to find discipline with. And in order to do that, part of that discipline is first identifying what you're going to be disciplined around. So I know that I may be droning on and on about this, but it's damn important that you first discover what your routine is. Write it down. Put it on a piece of paper. Tape it on the wall right in front of you. Let's see here. I'm glad there are people commenting. If you have comments, please put them up there. I'd be happy to answer your questions. And let's see. I don't know how to pronounce that. Hugo. How you doing this morning? And Jerry are here. If you have a comment, please put it in there. If you're enjoying this series, please give it a thumbs up and subscribe. If you're giving me a thumbs down, right? There is one thumbs down. I would like to know why. Don't just put an empty thing. Don't be a coward. Tell me why you gave me a thumbs down. Otherwise, a thumbs up. I'm giving you solid advice. If you think that what I'm putting out there is crap, then tell me why. Maybe I can improve it. Or the people who think that I'm doing a good job, put that thumbs up there and drown that person that put that one thumbs down. I don't understand that. I come on here and I'm providing you professional advice. You're getting advice from somebody that has 40 years of experience in this industry. I've been an institutional trader, a hedge fund manager, and before that, I was at the top of the heap in terms of a technical background, where I was chief architect of a Fortune 50, literally in the area of fintech. So this is the place where you want to be. All right. So thank you. All right, Coach, are participants able to review these sessions at a later date? Yeah, absolutely. All of these are recorded, and you'll see them on my YouTube channel right below. And it's called the Fly on the Wall, or FOTW playlist, right? So they're all under that category. So every Monday, you're going to see 3 episodes for Monday, Tuesday, and Wednesday. Thanks, James. And Milo, good to see you live streaming on YouTube again. Still remember watching those end-of-day experiments. Those were fun. Thank you very much. Yeah, I plan on making this a regular thing, and we're back. We've never really gone anywhere, but I did take a break from live streaming for a while to develop a new program. So I've had this Zero DTE business now since March of 2021. And it's primarily a coaching business. And over the past 6 months, we've really gotten into some of the weeds here, and I've been developing a new product. And I think that's probably the most interesting thing. It's called Fly on the Wall. And it's really a sidecar to your brokerage. You'll be able to use this product to do all your analysis and then also sending and executing your trades. From an analysis point of view, it is the perfect tool for analyzing zero DTE trades. It's a lot like a Thinkorswim and their risk graph, but actually it's way easier to use and way more powerful. That's also in active development, so when you join, you'll be getting the tool, you'll get our Discord, and you'll get these live streams Monday through Wednesday, and then on Friday, there will be a one-on-one or a live interactive coach call. So really great service. Look down below, join it. You can join the Observer tier, which is a trial. It's a paid trial, but it's weekly, so very little risk. All right, so we're going to get back to why we're here. And that the market just opened, by the way. We'll review what happened Monday and Tuesday, and then we'll start getting into our routine. Now, our routine is pretty simple. Every day, we're trying to figure out how we're going to approach the market, where volatility is, so that we can figure out how much we're going to expose ourselves, or what's the limit of exposure that we can have based on that volatility, which will determine the rate of decay of premium. Then we'll look at the volume profile, which will tell us the market structure. We need to know that so that we can figure out where the trading opportunities will be. Market structure will tell you where support, resistance are, where liquidity and illiquidity are located. That'll help you develop a plan. And then you want to always trade with the trend. Now, we don't know whether or not the market's going to end up or down that day, but we do know that we can readily identify what the trend is and trade with that. Now, here's the interesting thing. Even if the market, let's say you have a bearish bias and you're going to trade to the downside, even if the market ends up that day, at the end of the day, believe it or not, there's still opportunity to make profit on a downward trend. That happens quite often. As a matter of fact, it happened yesterday and Monday. Monday was a green day, but it was also a down day. I guess it depends on where you start. But over the past month, since really the beginning of the year, we've been on this sort of consistent downtrend. Here's the interesting thing about trends. It doesn't matter which way the trend is. Any given day can be up or down, end up or down. In fact, if you look at any long-term trend, if you count the days that were up versus the days that were down this past quarter, you'll find that it's about a 50-50 shot, even though it's a downtrend. And it's the same thing when you have an uptrend. So that should tell you something. So then why do we trade with the trend? We trade with the trend because the average magnitude of the day, or the average day, the size of those moves will favor those down moves over the up moves. That's what actually makes the trend. Now, we don't know if it's going to be up or down, so that's why we pick our bias. And it's a small edge, but it's still an edge, because the average move, if it's a downtrend, is going to be lower. That means there's a greater chance of us getting into our profit tents. We're not aiming to get in the profit tent, but that's why we trade with the trend. It gives us that slight edge there. So on any given day, if you think, oh, it looks like it's going to be a reversal day, so I'm going to go bullish, you may find that was the wrong move. Right? I still am bearish. Even though today we're up 2 days in a row. Actually, if you look at it 3 days in a row, I'm still bearish. And you can still make money on those days that go against the trend. That's the key. So anyways, we're looking for trend. We're looking for market structure. We're looking for volatility to figure out how to right size our trades. So why don't we get to that first? We're executing our process right now, our routine. And while we go through it, everything that I show you should be part of this journaling and reflection process. So you, again, during the day, you have your preparation, execution, and then reflection. Your preparation and execution should be, you should be journaling or creating a chart, marking up what you felt was today's opportunity. Record that, put it into your notebook or to your daily journal, your planner, whatever it is. Put it on your file system. Have some sort of organization for each day. All right, so we'll start that. I started every day by looking at the VIX, and we'll go to that right now. This is my VIX playbook. It's where I decide how wide I'm going to make the butterflies that I plan on trading. And we're typically doing the classic out-of-the-money fly. That's an out-of-the-money butterfly. The other strategies, the Batman and the time warp, are and also the big ass fly up here, they're all edge cases to a 0 DTE trade. And they are for extreme cases. That's what an edge case is. Now, the Batman, the first few days of this week, a couple of days of this week and last week, was definitely something that was in play. And you can see the Batman is a trade where we take an out-of-the-money fly and put it both below and above the market. And you can see here that we do Batmans when we're in the chaos zone. We'll do Batmans 90% of the time. When we're in the upper side of Goldilocks, we'll do them 60% of the time. So it's a spectrum, right? And when we're about where we are now, we'll do them about 30% of the time. Does that mean you're going to do it today? I would just flip a coin or just think about what your general feeling on that is. Am I going to do a Batman today? I'm going to do it maybe 1 out of every 3 days or so. You don't have to. You can stick with the out of the money fly. I'm just saying that that's where the way I would look at it is I would want to do a Batman when I thought I had the best opportunity to profit from it. And your profitability goes way up as volatility goes up. And it's the same thing with the time warp. Time warp is a bit different. It's on the other end of the spectrum for super low volatility. So we don't even start doing it until we're down in the zombie land area. On all other cases, we're just looking at a simple out-of-the-money classic symmetrical butterfly that follows our risk to reward range that we're looking at. I talked about that yesterday, where I said that we're trying to, at the maximum, use the 10% debit rule. That means that the most we'll pay for a fly is 10% of the width. Now that's important. That's telling me that I don't really need to know what the strikes are. As long as I follow that edict, that I follow 10% of the width, and I go with the direction, whether it's going to be a call or a put fly on that day, then that's going to dictate exactly where that butterfly is going to show up. So that's the key there. All right, so today, I know I'm just jabbering on, but I want you to understand exactly why we're doing this. If you're wondering why, first of all, as I said, it has everything to do with the rate of premium decay, and that is a dramatic occurrence that is dictated specifically by the amount of volatility in the market. And the market will price options based on that volatility. That volatility will determine how much premium is available on that 0 DTE day. And on high volatility days, the premium is expanded. There's much more premium available. You can say that the decay rate has been delayed. So in other words, all the premium backed up and it's still there on that 0 DTE day. At the end of the day, it's still going to zero no matter what, but there's way more on high volatility days. On low volatility days, it's the exact opposite. A lot of that premium has already been decayed the previous days. And so on that 0 DTE day, we have much less. And that's what really determines how wide we go and the nature of our butterflies. If you want to know more about that, go to yesterday's, I'll call them lectures, or yesterday's show, and where I go over in great detail exactly how you can see that huge difference when you have high volatility versus low volatility. And that's the basis of everything that we're doing here when we're putting on these either very wide flies or narrow flies. So right now we're in the middle of the Goldilocks zone, so we're somewhere between 30 and 40, maybe 35 to 40 or so, depending on what your account size would dictate and all of that. You can choose one way or the other. If you can't afford to put on an SPX that's 30 wide, then look at XSP. That's a 1/10 size. Or look at the E-mini futures, which is about half the size of the SPX. So there are a lot of options that you can do to right size it for your particular account. So in any event, it looks like we're about 30 wide, 40 wide. We'll call it 35 wide, right? Split the difference. It's a spectrum here. The next step is to check out the volume profile. And we do that by going on a daily chart and turning on our profile. And as you can see, I've marked up the profile in the area that we're trading right now. Now we're starting to climb here, so it's possible that we need more lines in here. And I'll show you how I do this. I'm outlining the nodes and the deep cracks. As you can see here, there's a big, huge node here. There's a mammoth node that's multiple heads, multiple subnodes on it, like a hydra. And then there's this big, deep area that I call a volume. Some people call it a low-value node versus a high-value node. But I like to call it a volume because it's really like an anti-node. And it does have a small, what I would call a child node right in the middle of it. Here, I'll get rid of the lines so you can see them very clearly. So we've got this like child node here, big node up here, and a mammoth node with a bunch of small spikes in it, Hydra's head. Each of these features are going to be 100% in your wheelhouse in identifying where those structural levels are. That's going to show you where support and resistance lies, and also the way price tends to behave. In general, when you have a low liquidity area, price is going to move very fast. That's where you're trending. As a matter of fact, you can see it very clearly that we're trending here. And when we came down, when we got into that low liquidity area, we trended down. And the reason why is that the market's spending less time in this area here. Why? The market doesn't find value there. For whatever reason, it found more of it up here and more of it down here. And so you'll find that as price continues to traverse across these areas, these levels will stay persistent over time. Not over just a day or a week, but months, years, even decades. Of course, we've been just going up, up. The maximum that you'll ever see price sort of retrace might be 2 years, maybe 3 years. In some cases, I've seen it as much as 8 or 9 years. But recently, it's only been a few months because we've just been on a tear. But you can see that when we had this pullback here, you could go back almost a whole year, and there will be price action that would have contributed to the volume profile. Where we're right here, price action goes back to about the middle of last year. If we go down a little bit, it would go all the way back to the end of 2024. So we need that volume profile in our wheelhouse so that we can evaluate it, because the features here will be directly affected by that price action. And you might not think that it's worthwhile plotting, but I can guarantee you the institutional traders, the market makers, all of them are looking at that profile, those profile levels. And in fact, they're lining up on the edges of those levels. And you'll see that even when you examine your gamma exposure, you'll find that those gamma walls are also lining up in accordance with those profile levels. You can think of the volume profile as the aftermath of the swarm of activity that occurred. And that swarm is going to be very consistent about where it finds those nodes and the lack of nodes in those deep crevices over a long period of time. All right, I'm getting a question. What are your volume profile settings? On here, what I do is I try to get maximum resolution. What I set my trading view at is I use the number of rows, and I'll put a very large number, depending on what your monitor can handle. I have a 6K monitor here, so I could put 2,000 rows. I don't think it's going to give me much more resolution, but it really doesn't look that much different. Maybe a little bit different. You just saw it redraw a bit. But put a large number there for your monitor, between 1,000, maybe 1,500 or 2,000. This monitor is super high res, so I can handle 2,000. I tell most people put 1,000. That's usually good enough. That will give you the kind of resolution you need to discover the nodes and those deep crevices. And for volume, always use total volume. Do not use up, down. It's not going to give you any additional information for you. In fact, it just gets confusing. Use total volume. And for value area, this is like the bane of my existence. Value area is showing, it's going to highlight the areas what areas are showing the amount of volume for the percentage that you put in there. So normally you'll see by default, it'll say 70%, right? Something like this. And you'll see it redraw, and you'll see that part of the area is bright blue and the other dark blue. What it's saying is that 70% of the volume on this chart is being held in that light blue area. How does that help you? It doesn't. A lot of people think that the edge here means something about one standard deviation, but they're not even using the proper percentage for standard deviation, which is actually at 68.2 something, 218 or something like that. So that's superfluous. So just keep that at 100. So those are my settings. I'll keep this at 1500. That's probably good for most people. All right. That's right. The market has memory, and VP shows it. Do you select adjust for contract changes in VP settings? Absolutely. Thanks for that, Dave. When you're looking at the volume profile, you might look at the settings for your price action here. And although it doesn't matter as much on some things, but for the ES, we know that those are futures and they have 3-month contracts. I always have adjust for contract changes here selected. You can either have it unselected or selected. Have it selected. That will draw the profile appropriately so that you can do an accurate profile setting. Thank you, Dave. All right. So there are my settings. Now, what I do is I mark up the nodes, and I typically will put a red thick line on the top of a node and a green thick line at the bottom. And then I'll use yellow in between the nodes, and I'll use blue inside of the nodes. All right. So once I've got it all, and the reason why I do that is when I zoom in, I can't see the volume profile anymore. Because I'll be looking at the visible range, it'll only show me the profile for what I'm viewing. If I zoom in on a 5-minute chart, I've already marked it up, so I can actually get rid of the profile at that point. So that's what we're going to do. We're going to go down to a 5-minute chart because we're day traders, mostly. And so you can see here are my lines that I all marked up. It'll have some relevance to what the volume profile is showing here, but this is only showing me the past few days. So what I do is I just turn that off and rely on the profile. This is going to show me where support and resistance are. And you can see yesterday what we're looking for, because we're in a downtrend, we're looking for moves that do this. Downtrends typically do something like this. They move up and then down, then they move up, down, and then they'll move up and down. That's basically what a downtrend does. You notice when it moves up, if you're trading with the trend, you always want to get that pullback, right? Because that's your most opportune time to get the maximum potential out of the continuation move. Now, when it pulls back, it is almost invariably going to pull back to a structural level that you marked up. That's the key, right? And you'll see that every morning, that's what we're doing. Here's Monday. It pulled up to the structural level right here, right? We take a put fly down here, and it moves right into a put fly. Same thing happened here yesterday, although it reversed on us. There was still an opportunity to get out with a very small profit. Or if you didn't take this trade, you probably never would have gotten into the trade. Or you might have found up here was an idea of getting into a trade. But in any case, yesterday was probably going to be either a flat, small profit or loss for you, or no trade. At worst, it's going to be a no trade. And because we're taking asymmetric positions, that means that our loss is going to be very small. As opposed to Monday, where we had a nice big move, ended up being a very healthy profit. So that's what we're looking for. We're looking for small losses or small wins or big wins. That's where you want to be. Small losses, small wins, medium wins, big wins. I like that math. And by waiting for a pull up or a pull down or a pull back, whether you're bearish or bullish respectively, those are the best times to get in. We're trying to get in on the morning session. You notice that I have it broken down into sessions. And so here we are today. All right. So let's zoom in on today. You can see very clearly that we have, here's the bottom of a node, and then here's the top of a node. I know it by the coloring, right? Red is at the top of the nodes, green is at the bottom of the nodes. And so these are relatively close nodes here together. But we started the market moving up into a node, and then it got rejected. Right? So you may have considered taking a position there, but so far it looks like the market is moving at a pace that is outside of our control here. I would be looking for something like this, a move up into this area and then take a put fly down here. If we move up into this node, perhaps we'll move up here and just continue up all the way up. You might want to take a look at this node here and see whether or not there are other structural elements. So let's do that. We'll go back to the daily chart. All right. So that's this guy here. Yeah, I can see a structural element right here. So when I'm inside of a node, I make those lines blue. So I'm going to say that there's one right there. And let's make that a little skinnier, and we'll make it blue. So structure inside of a node, I color blue. So now if I go back there, you'll be able to see that. Turn off the profile. And so there's the blue line. That's part of that structure. There were other features in here. There was definitely a crevice in there as well. Go back and check. These are all unbelievably telling and useful. So pay attention when you're marking up your profile. There's a reason why there are edges to nodes and crevices inside the nodes and in between nodes. And that's because the market has decided where they find value and where they don't. And they're already mapping this all out. I'm telling you from my own personal experience as an institutional trader, this is what the pros are looking at. Okay, there's a question. Are you using a fixed range or anchored volume profile? How far back in time do you go? You go all the way back. You always use a daily chart. You go and you use all the profile that's available, all the price action that's available. So when I'm looking at this, I go until there's no more price action to the left of me. And I must build the profile based on that. You use all of the information. All right. Here we are. Prices right around here. We're inside of this node here. And I can zoom in on that a little bit and maybe get a better feel for it. Let's let it redraw. And I already put up this line here on this little crevice here, there. And I would say that this is also a significant area level. See, what I'm looking for are these deep, long edges, because they're all going to provide support and resistance in there. And there's even one below there. I know this is getting a little bit in the minutia, but it's worthwhile. Deep crevice right there. And they're subtle, but there's a reason why they're there, because that is where the pros are lining up. You'll find that if we go back and over these various nodes, that they're not going to change significantly in their shape. They'll always have the edges and they'll always have those deep cracks. Why? It doesn't matter why. All you need to know is that is where the market has found value, and that's where they have orders stacked up. That's where the market makers have inventory, all of that. All right? So, like, for instance, I could put another blue one right here inside this node right there. And we're not down there yet, but I'm just showing you how you mark it up. All right? So I use a day chart when I'm marking it up. When I go to my 5-minute chart, I don't need the volume profile anymore, so I close it. And I use the markup that I've used. All right, so here's another blue line that I put in there, and you can find that, okay, it's had relevance there too. These aren't perfect. It doesn't mean that the market is always going to hit it. You'll find that in most cases, it is hitting those structural lines. I'd say 80-85% of the time. The market is a random walk for the most part. But in that random walk, you have structure. It's not completely random. So anybody that's told you that the market is completely random, then it would all look like noise, but it doesn't. You examine the market, you'll find that it is following these structural levels to a T. Right? And then the behavior in between nodes versus inside nodes is very different. The market trends about 75% of the time, 25% of the, and those 75%, it's mostly trending inside of a low liquidity area, which makes sense. Right? And then when it's consolidating inside of a node, again, makes sense. That's why the node is there, because the market found value there. And so it's hanging out there more and laying down more tracks. That is what's happening. Now, we're here to talk about reflection. And when I am marking up something like this, is all part of my record for that day. And so what I would be doing if I were you, right? I'm telling you, this is part of your journaling. I would be taking a snapshot of this and where you've marked up things and where you think that price is likely to give us a trading event. In this case, like I said, we're waiting for an event to come up into a structural level and then move down. Now, it already did it very quickly here earlier, will it do it again? So I'd be looking for something there and possibly here. Again, it doesn't have to hit the level exactly. It has to be within that range. A lot of times you'll see it that it hits it, it's spot on. The other problem is that when I'm drawing these levels, I can't be perfect. I'm usually within a point or two. So that's what we're looking for. We're looking to hit up. I'm telling you that's what you should be looking for, because that is what the pros are doing. I'm telling you this from my own personal experience. It is that way also with currency traders. They make their living off of levels. Those levels are defined 100% by what the market and the industry has decided where there's value and where there isn't. That's the key here. It's not trend lines. It's not moving averages. It's not whatever fair value gaps or any other crap that you decide that you're going to use. It is the profile. And you should be marking these up, taking screen snapshots, putting them into a folder. Maybe you should create something on your file system for each trading day and put all of your artifacts in that folder when you're planning things out so that you can review it over time. Maybe you have a journaling application. We have a journaling application built into our fly on the wall. And it will also find your trades that you took that day and attach it to your journal. You'll also be able to tag your journal and your trades in fly on the wall with either user customizable or some of our standard tags. Those are going to be your trading lexicon, right? And over time, you will develop that. And that's very important too. Because you're going to review these, not only you need to do this throughout your trading day, summarize what you're doing at the end of the day, and then at the end of the week, you're going to review it and look at your full week and what your progress was, how you executed, how you set up things, what your routine was like each day. So Dave's asking, so we are waiting for a pullback to one of those levels. Yes. Then this is where we place our trade. No, it's not where you place your trade. That is where the trading event happens. So right now we're coming up to one of these levels. This is where a potential trading event is going to be, right here. That means I now need to put on a out-of-the-money butterfly. Where? We're bearish today because we're in a downtrend. So we're going to put on a put fly that is out of the money. Where's it going to go? It's going to go based on my risk to reward strategy. All right? My risk to reward strategy says don't pay more than 10% of the width. So if we have a 35 wide fly, we're not going to pay more than $3.50. Now, I have a range between 5 and 10%. So that means that we're going to pay somewhere between $1.75 and $3.50. I like paying less, quite frankly. But that also means that it's going to be pushed a little further out of the money. You might think, holy crap. Oh, you meant when? That's a good question, Dave. When? Well, it's when you think that it's going to turn around there. Now, there are a lot of ways that you can make that determination. Some people like to use price action, candle patterns. Some people like to use divergences. Others like to use gamma and see if we're not hitting a gamma wall or what side of that gamma wall that we're on, what's the probability. So there's a multitude of ways that you can determine. You can use all of those methods. And we, in fact, do use all of those methods. Now, I don't know if it's absolutely going to work at that level. It may start to work, and then the market might decide to go right through it and go straight up to the next level. I just don't know. Again, that's one of the reasons why we take our small risks. We know that most of the time we're going to be pretty correct if we're using those levels and we're using our technique to figure out whether or not the market is going to turn there. Price action, patterns, GEX or gamma exposure analysis. Divergences is another good tool to use. All of them can give you good hints on whether or not that level is indicating or the market is indicating that it's going to turn. The key is that the chances of it turning on one of those levels is very high. And we can accentuate that or improve our probabilities by using the other techniques. To say that there's a definitive way to tell whether or not the market's turning there, that's not possible. But let's say that we've determined that's, for whatever reason, that's going to be it, because it's happened many times before. You can see overnight we had strong turnaround right there. That's laying down tracks, telling me that's where the market is finding resistance. Now, it tried to go up inside of this node here and got rejected. So there's strong evidence, and the reason why the line is there in the first place is that historically there's been a lot of evidence of that particular level. If I go back far enough, you'll find it. That's why it's there. So what do? I'm going to put on a fly down here. So the idea is then to put on a fly down here that meets my risk to reward requirements. And then now I'm in a trade and I'm ready. So I like to journal that sort of thing and log it, obviously. When I put on that fly, that's going to be part of my end of day record. And if I have any particular reasoning why I put it there or why I chose a 5% of the width or a 10% of the width, one way or the other, if I felt that I was putting it in an area based on the GEX, for example, I'm looking at the GEX and I'm saying, oh, we're in positive gamma here. Let me put on the call put view here, or this is the net view. All right, so we're in positive gamma up here. That means that there's a great deal of friction. We're moving up into a wall. However, it's fairly uniform as we go up, and so we could easily climb up here and away from that put fly. However, we're also very close to what would be called a flip zone. And if we get beyond this gamma wall right here, it could be a slippery slope. There's going to be expansion down in this area. So there's compression up in this area, expansion down in this area, and you can see these little dots showing us where potential flip zones are. So I would think that if we drop down here, there's a good chance that we continue to move down. If we stay up here, we could grind higher. You can see I also have the volume profile under there, so you can get a better view of that. James asking, do I use convexity to help you determine direction or where to put the fly? Convexity is used to, let's describe what convexity actually is. Convexity is that point where the rate of change of the price of your fly is going to change dramatically. And the heat map in our Fly on the Wall app is designed specifically to help us identify where the convexity level is. So what we're looking for is an abrupt change. You'll see that there's a colorful change throughout here, and it's a little scattered at this point. Sometimes when you go to the theoretical model, it might give you a slightly different view, but what we're seeing is the debit price of each of these flies. And if we're on 35 wide, that's this level right here. Let's see, I'm going to bring up my annotation pencil. 35 wide is this column right here. And we're looking for something that is 35 wide, 10% would be right here. But you can see that there is a much cheaper alternative the next strike down at 270. Now, would you pay $365 or just two strikes down or $270? $1 less. I mean, that's like a no-brainer. I'm going to be choosing probably this fly over anything else. And you can see that it's continuing to drop. And that's, even though it's two more strikes out of the money, that's telling me, this red area is telling me that's where convexity lies. That's where the rate of change of the price of your position is changing more rapidly. So it's kind of like the hockey stick. If you had a chart that goes like this, and then all of a sudden it does something like this, that's the rate of change. Here's your current rate of change, and then a different rate of change. And that's happening right there. That is what this chart is attempting to highlight for us. We can adjust this color area here by moving this here and bring it a little bit more into view. So where that red area, or the darker blue and going into red, you can see up in the call side it's getting very uniform. And as we go later into the day, you'll start seeing these changes across the chain starting to get very uniform. But generally you'll see nice and bright blue in the middle and then turning red either above or below or dark blue. So that means that the rate of change, or that convexity level, so the rate of change, here's the rate of change, and then that convexity level's doing this. Actually, in our case, it's going like this. And we're looking for that area. That's in here and in here. The calls are much more defined. It's all here. That's where the rate of change is the greatest. And as it stays red, that's where the rate of change is greater. It seems like put flies today are not as organized as call flies. But that can change very quickly, where it's only 40 minutes into the market. And it will change. You'll find later in the day that we're going to have uniformity. This, by the way, the heat map, the convexity heat map, is unique to fly on the wall. You won't get this anywhere else. And it is the easiest way to find the most optimal trade, where you might go to Thinkorswim or Tasty and start building your butterfly, and then you have to drag and drop it and then view it and see what it's like. Then go back and create it, and if it's not, then you have to go back and change it. And you don't know what it's showing you relative to all the other possible selections. You have to keep on going back and forth. Here, I can look at every possible fly at a glance and tell you exactly which ones are priced relative to the others. So I can pick it almost immediately and put it up onto the chart. So let's say I'm at 35 wide and I like this one right here. Then I just choose it and it puts it up onto the chart. Bam, done. Right? That's how quick it is. So let me tell you a little bit about this tool. And I'll go to the big head and give you some info. This is a super advanced options trading platform that is designed to be used as a sidecar to any brokerage application. And we're actually building in modules that will allow you to send your trade directly from the platform to your account, whether it's Thinkorswim or Tradier or IBKR, or if you want to just do simulated trading and then do it however you'd like and do it inside, we have our own brokerage set up that is a simulated broker, and it will mimic real-life conditions by looking at liquidity and the spread and give you some friction so that you're not just getting optimistic fills. But other than that, it has the tools that will allow you to see your position relative to volume profile and your GEX. Again, completely unique to our platform. You'll be able to pick your trades almost immediately by looking at the heat map. Again, completely unique to our platform. You're getting a GEX tool as sophisticated as the most sophisticated tools out there. Again, completely unique and in combination to our platform. So if you're interested in these kind of tools and you want to be involved with a huge group of other traders that are trading this every day, you'll be in our Discord group, you'll have this tool, and you'll have coaching sessions. Go down below, select the Observer tier. It's a weekly for 4 weeks. You can cancel anytime and find out what it's all about. Sorry for the shameless self-promotion, but hey, if you want to use the most sophisticated tools, they're available to you, and they're here. Why? And what makes me some sort of guru on this? Because I am. I've been involved in this market from the very beginning. In fact, during the dot-com era, I was building the systems for the exchanges, for the NASDAQ, for the American Exchange. We built the systems for all the major banks, for Goldman, for Credit Suisse, for TD Waterhouse, UBS. My team literally built all of their systems. All right. In fact, where did I come up with the 10% debit rule? I discovered that when I was down on the American Exchange and watching the options traders, and I asked them, why are you picking those out of the money flies? And they said, oh yeah, that's our 10% debit rule. That's where I first learned about it. So I've got deep ingrained knowledge specific to the actual pros that implemented this. We've actually improved upon what they were doing, and that's really where our zero DTE strategies originate. All right. So let's go back here. So we have chosen our fly. Our next step is to wait. Is it going to go towards us or not? If it goes against us, if it goes this way, okay, I can deal with that. Am I going to manage that risk? No. Why? Because I've already defined my risk. That's my risk. There is nothing to manage. If it starts going this way, this is when I manage it. If it starts making some profit, let's say right there, that's when I'm going to set an alert or decide to start managing my profit. And generally what we're doing is we're putting in a dynamic trailing stop there. So with our tool, as you can see, I can right click if it maybe put an alert right there. And when it comes up there, that may tell me or alert me that I need to start paying attention, because I'm sitting here and I've got almost $300 of profit. I don't want to let that go. So I'll figure out exactly where my trailing stop is, probably about 40 to 50% below there. And I'll place another alert right there. And when I'm in that trade, as long as I stay above that red line, I'm in that trade. All right. And hopefully it will go all the way to inside the profit tent. But even out here, I can make anywhere from 50 to 250% return on my risk. If it gets in here, I can make up to 1,000 to 1,500% return on my risk. So that's our strategy. Now, while I'm going through all of this and I am managing that, I am 100% tagging my trades, journaling, annotating my charts, saving that information, and logging my trades and logging my actions, logging also my personal readiness, how I feel that day. Am I anxious? Am I bright and cheery? Am I 100% on it, on my game? Whatever. All of that is important information for that day's trading. Jerry's asking, once you've chosen your price and trade on the heat map, you can send the trade to your platform like Charles Schwab's Thinkorswim. You will be able to. We are developing that right now. The first implementation is going to be for Tradier, and we're going to actually have a special deal with Tradier where they'll literally give you a few months worth of free service from us by putting money in their account and using our tool. But eventually you'll be able to plug in Thinkorswim or IBKR or Interactive Broker. Yeah, it's coming, Jerry. Thank you for asking. We're running a little long here, so I want to finish up on this idea of reflection. So after your trade is done, and you've journaled it from your preparation, your execution, your management of it, you've logged the trade, you've exited, you have the results. At the end of the day, you want to do your reflection and see if there's anything else that you want to add to that and put it into your journal. And then button it up. At the end of each week, you'll return to each day and provide a summary report. Now, that sounds like a lot of work. And it can be a fair amount of work, but look, if you want to become a successful trader, you need to close that loop so that you can start understanding, am I making improvement or not? And identifying those areas where you're weak and where you're strong so that you can put into place action cessation plans so that you can focus on them and improve that practice. The number one thing that's going to improve your practice is repetition and developing those good habits over and over. And the only way that you're going to do that is identifying what are those good habits that you need to develop. If you do not record, if you do not log, you do not journal, there's no way that you're going to have a basis for what needs to be improved. And a lot of this stuff is going to seem subtle. That won't come to fruition unless you actually do that kind of work. Our tool is designed specifically to help you capture that information, tag it with your own trading jargon, save those charts to your journal, and then be able to generate a retrospective at the end of the week automatically with performance. And from there, you can develop truly useful mitigation strategies or mitigation actions that you can take If you can see that I'm a little weak when it comes to execution or getting out of that trade, I always get out too early. There must be a reason why. Through that recording, you may find, oh, that's why. And so you can then adjust that behavior and improve upon it. Maybe keep yourself into that trade a little bit longer and try for those higher end returns. But you won't know that unless you're actually doing the work. And our tool helps you do that work. All right. That's about all I have to say. I want to thank everybody. I hope you all have a great long weekend. We will have, I don't know that we'll have a Friday coach call because it's going to be Good Friday, and so a lot of people won't be here. If we don't, we'll see you in the Discord. For that, thank you all very much. Hope you all have a great trading day. Coach Ernie, out.